let's consider an alternative calculation for the required rate of return on common stocks. And this particular method is referred to as the CAPM method. CAPM stands for Capital Asset Pricing Model. Now, the Capital Asset Pricing Model is a very important development in finance. There are several Nobel Prizes that have been awarded for the development of the Capital Asset Pricing Model. And it's really very elegant. It's a fairly elegant model. Now, the criticism of the CAPM is, while it's a wonderful theoretical model, there are some questions as to how well it works in practice. I think we can certainly say that the world ought to work this way in practice, but in fact it may not work this way in practice in many cases. Nevertheless, if you're going to study further, if you're going to take further finance courses, you're going to be exposed to the CAPM in much more detail than we're going to discuss it right now. But let's just lay out very basically what the CAPM model is and what the argument is for why it should work. And in this model, we have KJ here, which is the required return on a common stock, the common stock of company J. So this is a particular company's required return on its common stock. And because stocks are risky, you expect a corporation's stock to earn more than the risk-free rate. In other words, in order to take extra risk, you should have to you should enjoy a higher return, or you should be able to expect a higher return. So the cost of common stock, or the required return on common stock, is equal to the risk-free rate plus a little bit more. So it needs to earn more than the risk-free rate. So R sub F here is the risk-free rate. Well, how much more should a stock earn? Well, for right now, let's forget this little beta. I'm going to mark it out. And let's consider sort of a typical stock, the average stock in the market. Well, the average stock in the market is going to earn whatever the required return on the market as a whole, call that KM, minus the risk-free rate. That's the extra amount that sort of the market as a whole on average should earn above the risk-free rate. In other words, the stock market should earn above the risk-free rate. So we refer to this KM minus RF, this little box right here, as the market risk premium. In other words, the extra amount that the stock market earns on average above what you could get investing in a risk-free asset. Typically, we think of that risk-free asset as Treasury bill securities. Okay, so if we assume away that little beta, RF plus KM minus RF, we would just get on this side. The RFs would cancel out. We would just get a typical stock should have a required return equal to whatever the required return is for the stock market in general. So that, in essence, would be the very basic case. If you just had an average stock, it ought to earn what an average stock in the market earns, this little KM. So if company J was an average stock, it ought to earn just KM, which should be more than the risk-free rate. Now, it turns out, of course, that most stocks aren't just average, and that's where this term beta comes in. Beta it's called the beta coefficient, and it measures the historic volatility of an individual stock's return relative to a stock market index. Basically, what it does, beta is a measure of how closely security J moves in tandem with the rest of the stocks in the stock market. And if when the market goes up, security J is likely to go up as well, and to go up a lot, well, then the beta is very high. So a very high beta may be 2. If the stock doesn't seem to be at all related, if the movements in the individual stock J are unrelated to movements in the market as a whole, then beta might be 0. The average beta and I think we say this here. No, we don't. The average beta is equal to 1. So betas above 1 means the stock moves more dramatically than the market as a whole, but tracks it fairly closely. Betas of 0 mean they don't track the market at all. It's possible to have betas that are negative, but in general, beta is 1, a little more than 1, a little bit less than 1. A beta of 3 would be highly unusual. That would be extremely high beta. And betas that are negative would be very, very uncommon. In any event, to sum it all up, the cost of capital, the required return on common stock for security J, is equal to the risk-free rate plus a little more, and the extra that it is expected to earn is partly a function of how much the stock market in general is expected to earn above the risk-free rate, and then it's also a function of how much exposure to the various risks in the market. So the exposure to the market, how much exposure there is for this security J to the things that move the whole market. Erase a little bit. In this case, let's assume that the risk-free rate, in other words, Treasury securities, are 5.5%. The stock market is expected to earn 12%, which means that the risk premium, 12 minus 5.5, is 6.5%. This company is one of average risk, so the beta is 1, so beta is a measure of risk. And we simply plug these numbers into our formula above: beta of 1, KM of 12% minus 5.5%. Risk-free rate was 5.5%. We're going to simply plug those numbers in, which we've done along the bottom. And when we do that, we come to a required return of 12%. Let me clean up just one moment here. Notice that our beta was 1. Our return on the market, required return on the market, was 12%, and we get exactly 12% for our return on this particular stock as well, and that's because whenever the beta is equal to 1, a company should earn just an average return, should earn what the market as a whole is earning. If you take further finance classes, there will be a great deal more attention given to the capital asset pricing model. This is just to lay out the very basics of it, but when you see that equation, the cost of the required return on common stocks equal the risk-free rate plus beta times the market risk premium. The market risk premium is just the items that are in parentheses here. That's the market risk premium.